you got to stop and think about something. We're still running those 7% deficits. And when you think about how GDP works, I see absolutely zero sign of fiscal discipline anywhere on the horizon, regardless of what happens politically.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots. I'm Zach Abraham, and I am joined, as always, with the brain trust himself, Mr. Chase Taylor. It's Fed Day. That's obviously the most important thing. I will start with a caveat before we get into all the details. Remind you once again, market action on the day of Fed Day and typically the day after Fed Day means virtually nothing about the direction leaving it. So do not try to look at markets today and make sense out of anything. I don't think there's a lot to be made. But let's get into, we got the cut. I still get cracked up. The headlines start popping up. Fed cuts by 25 basis, like it's news, right? And you're like, well, it's been priced in. So Fed cuts, but really, I don't think there's any interest or any intrigue in that. We knew that was coming. But when it comes to remarks they made and comments they made, that was interesting. Why don't we go through that? Why don't we start there? We can get to markets. I don't think markets are that interesting. Mostly flat, other than the Dow. And
they were wild intraday as normal, but close to close, pretty flat.
Yeah, I mean, wild swings on gold up to a new record high.
We'll rip through it later.
Yeah. So give us a rundown.
So one thing is interesting. Yesterday we talked, hey, there might be dissents on both sides. There might be a lot of dissents, and we actually only got one dissent, and that was Steve Mirren and that was because he wanted 50 bips, which not surprising. So that was a little, So you had those other two people that dissented last time, and they did not dissent. I think part of this, and a lot of people really thought we were going to get the 50 bip cut. And the reason that made no sense to me was like, we have a meeting next month. So there's no need to step on the gas whenever you can just turn around and do another one next month. But now we have a cut priced next month and in December. So two more before the year's up. And they did nothing to back away from that.
Can we hold, I don't want to get off the subject here, but I do want to point something out. I think it's valuable for the listeners here. Anybody that was telling you that they thought a 50 basis point cut was coming, I think that's somebody that you need to scratch off your list of people you listen to. Okay, because I think that people say that again because markets have gone up and to the right for so long that there have been no consequences for being wrong. The reason I say if you thought a 50 basis point cut was coming, you don't understand the markets we're currently working in, and you don't understand how the Federal Reserve works. And if you don't understand how the Federal Reserve works, good luck in this environment.
Yeah. I think to me, what was most interesting and most frankly bizarre was the summary of economic projections. So people probably heard, the dot plot that comes out of this economic projections they do, where all the members, say where they think growth, inflation, jobs, like the unemployment rate, and then the Fed funds rate, where all that's going to be. They do it quarterly. So it's always interesting to see like how that's moving, because you get a feel for like what they think's coming. This is the crazy part. So we cut and we priced more cuts into this year than previously we had, which would tell you they think things are getting worse. And they even said in their statement that, hey, there's some downside risks here to the labor market. However, if you look at their economic projections, which is just a median of everyone's vote, essentially. They have for next year, for 2026, growth, they revised up from 1.6 to 1.8. The unemployment rate down. So there's big risks to the labor market, but they revised next year's unemployment rate from 4.5 down to 4.4. They kept this year at 4.5. We're at 4.3 right now. They revised inflation up from 2.4 to 2.6. So they're telling you growth is going to be better. The labor market is going to be better than now, and the inflation rate is going to be worse. But that means we better cut rates a bunch. That's why I meant like this. Like, the whole thing was like incoherent. So next year they have the policy rate. They had it at 3.6. Now they have it at 3.4. So they basically added a cut in the next whatever that is, 15 months, and they put it in this year because you only have one cut next year. So basically their view is the same as the market's view, and that is, hey, we're going to do a bunch of cuts and it's going to save us all, and we're going to have the soft landing still, or again, however you want to look at it. So you just party on because the rate cuts are going to save us all. Everything's going to be amazing. I found that interesting, and not only that, we have one of the dots, which is, let's be real, it's Mirren, had 3 50 basis point cuts this year, so 150 basis points coming into today for this year. And almost just as interesting is you have one dot that's above where we're at now. So there's someone that is essentially calling for a hike from here. So you have one pretty significant hawk and then obviously one mega dove. Just the whole thing was bizarre. And then you have someone that has the unemployment rate at 4.0 to 4.1 next year, which is interesting. And I want to know who that is, and I want to know what they think, growth and inflation are too. But it was interesting. And then to listen to Powell, like, he basically just hedged both ways. He said, you can consider this an insurance cut, which tells me, hey, we're not doing that bad right now. If you think of it as an insurance cut and not as like we have a problem cut. But he said, the labor market was basically fine, and now, well, it's not. So kind of all over the place, the way we kind of expected. I mean, I think we all knew going in, like, stagflation, which when you say growth and inflation both up, yeah, that's stagflation, right?
I'm cautious whenever I say this because I've said this before, and a lot of other people have said it before, and it's such a popular thing. Oh, policy mistake. For a variety of different reasons, and I think the conflicting data being probably the biggest one. I am the most convinced I've been in a very long time that the Fed is on the precipice of a policy mistake, either on the growth side or on the inflation side.
It feels like you're going to get one of those, right?
And here's why I say it. And I wrote this down in my notes before we even started. Here's why I say it. Anytime now this latest iteration, but I mean, you can go back to inflation being transitory, right? Anytime there's chaotic and conflicting data, it almost always leads to policy mistakes, right? And the one thing, and now, just because it's happened so many times in the past, right? Not hot hand fallacy, I'm not saying just because it's happened in the past, it's got to happen again. But these are environments where we've seen policy mistakes happen, right? For a whole host of reasons. And I can't get over that feeling that when I think about how opaque this is, when I look at the data that the Fed watches so closely and cares the most about, I think that data is probably the least dependable right now, right? Employment data right now. I mean, I feel like employment data could swing wildly in the next 16 months in a way that we've never seen it before. When you look at and I'm not saying it's going to, but I'm just saying, there's so many different moving parts here that, I mean, economy is always complicated. You've added layer and layer of complexity around this situation that you haven't had before. So what it leads me to believe, if history is any indicator, is that you're probably at the beginning of a policy mistake. We just don't know which side.
Truly. Yeah. And, like Powell talked about, like, we've never really seen this before where both the supply and demand of labor are just crashing. Like that, it's hard enough to figure out what's going to happen with the labor market when just one of the things is like really moving, but when they're both moving so much, so fast, and we don't have an accurate read through of real time population, and you kind of need that to know like where you're at in the job market, because like to have any sense of where the break even rate is. I was surprised because he kind of made it sound like, yeah, it looks like we might be below the break even rate for employment, and I'm just like, I don't know how you have confidence in that. Like, for all we know, the break even rate is flat or negative. Like, judging by net immigration, but you can get immigration statistics, but you can't get anything that you can lean on in near real time. That's more of a like, all right, and we crunched all the numbers, and then last year's data was this. We're pretty sure. It's not like a, hey, last month here's exactly what happened with immigration. So that has a really big impact on what they're trying to do, and like it's hard to know what's what there. Tom Keene made a good remark today. He said the dots were, he said it looked like the wingspan of a B-52, because like it shows you like there's this massive dispersion in where people think rates should be, not just rates, but growth and inflation, everything. Like nobody can agree because it's so wide open. And the funny thing is about the comment about having a policy mistake here is the crazy dots are probably going to be the ones that are right. Either the really low ones or the really high one. It's probably not going to be the people clustered towards the middle. That's probably the only outcome that's unlikely at this point. But I can honestly say I don't know which is more likely right now. I have a leaning, but
I think that if I'm looking at the map right now, and it can absolutely, it could change wildly in the next 6 months, but I think right now you have to assume slower growth and higher inflation. Right. Especially when I think about, let's go back to the structural side of it. Like, 7% deficits. You and I both know those numbers aren't coming down anytime soon. They're not. When I look at the pressure with what's going on in immigration, really hard to see people like AI. Well, yes, to some degree, but to where it has an economy-wide significant impact on unemployment, I still think that's a ways out. Now, a ways out, I don't think it's a decade, but I wouldn't expect to see a real impact to employment numbers via AI in the next 6 months.
Right.
But when you start look at the immigration issue, add all that stuff up, and I'm like, it looks like slow growth and higher inflation.
And that's what they're showing. 1.8% growth next year and 2.6% inflation. Like, that's a pretty good bit above target for inflation, and that's roughly trend growth.
And for those that are like, look, we'll say it again in the end. This is absolutely an environment where a market catastrophe could happen. You've got all the dry tinder there. But before you go off that dock, before you jump off that right, you got to stop and think about something. We're still running those 7% deficits. And when you think about how GDP works, I see absolutely zero sign of fiscal discipline anywhere on the horizon, regardless of what happens politically. And I would just say that GDP in a lot of ways, despite all the risks, because of that deficit, it's less threatened than it maybe ever has been. You know what I mean? Just bottom line is when you're running 7% deficits with a growing budget the way ours is versus a historical average of 2%, right? Your GDP is less vulnerable because a bigger swath of it is going to continue to grow regardless of underlying economic conditions.
Yeah, and the money supply is going to keep doing its thing because of the deficit. So
the opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
And the other thing is another one on that side of it is the immigration thing, right? Like, because in a weird way, is always the case, trade-offs in economic scenarios.
Yeah, it's a double edge.
Yeah. But it's going to be really hard to see an unemployment shock with that many people leaving out the back door.
Right. The funny thing about this is like you're trying to figure out like which way it goes, because less people straight up is literally bad for growth, because part of growth is literally the number of people.
Yes.
So your output, is going to fall. Now, it doesn't mean your output per person has to, but your output's going to fall. But on the flip side, that creates that supply and demand thing with labor where you may have wages pick up, inflation pick up, tightens up the economy. And then you have, you look at housing. Like one of my things has been to follow like real-time rent data really closely. Because if you thought like, okay, well, if we're going to literally go net negative on immigration, maybe that loosens up, apartments and stuff, and you can get rents come way down because there's just less competition. But it looks like supply is falling faster because rents have been basically negative for like 2 years, and now they're like inflecting higher, which no one's talking about for some reason, because all the disinflation people are anchoring to like, oh well, yeah, but like housing costs are going to keep it coming down, and they will for a while. But now that in real time rents are picking up,
Not if you're cutting rates.
that too. So let me talk about the data real quick because that's where it comes into this. So we had starts and permits for new homes, terrible. They were lower than last month. They were lower than expectations. Brutal. Not a good sign for growth or employment. But on the flip side, kind of a more leading thing, mortgage applications are legitimately surging. Like you're still, under the 25-year average and stuff like that, but you were at all-time lows essentially for the last year or two. Now you're back towards that like 2010 to 2014 range, still low, but if you look at like what it's doing, it's going straight up because, rates fell a bunch. So you have the 30-year fixed rate at like 6.1-ish now after being around 7. So that is starting to get people in. And if you can get that down to 5.5, then you have a huge like floor put under real estate, I would assume, as long as people have jobs anyway.
Then housing and affordability is going to shoot right back up.
So you very well may be setting the stage for a not funny pickup in inflation. And this is, I keep seeing people talk about like, oh, this is this is genius. They're going to get the rate down. They're going to lower that interest cost, and they're going to run the economy hot, and like as if it doesn't have the inflation trade off. And politically, inflation is incredibly important, and it feels like they are just like looking past the political issue that inflation could be in 2026. And for the life of me, I don't get that. I don't know why no one's in the Oval Office raising their hand and be like, what about voters and inflation next year? Like that might hurt in the midterms. But at the moment, it seems like they're willing to accept that risk and that trade off.
Yeah, I'll tell you what, and I mean this honestly. I'll have my critiques and I'll have my bones of contention, but this is one of those moments where I'm glad that making these decisions isn't on my shoulders.
Yeah,
this is a really and because of that, I'm inclined to kind of leave well enough alone. That being said, we go back to, I've got to constantly remind myself that we are not in pre-COVID policy. We're not in a pre-COVID era. We're in post-COVID era. And, I've got to remind myself to not think about things the way that I used to, where I'm like, the danger is inflation. Yeah, but inflation's also the only way out of it.
So economically, that's true. Like to me, that's obviously the case economically.
Yeah.
But politically is always a different animal than economically. And it almost feels like they're running policy like an egghead would, even though they're usually the exact opposite of that. And it was like, well, I ran the numbers, and this, you have to run the economy and inflation hot, only way out. But the problem is like people vote and people don't like inflation. So like now they don't like a lack of growth, and they don't like high rates, and they don't like any of that stuff either. But I mean, at the last election, if you ask people on those exit polls and stuff, like, oh, what was the big thing for you? And it's like, oh, well, inflation, like.
Yeah, which is confusing to me because maybe they legitimately think that they can do this without ramping inflation, which I don't understand. I don't.
Same. But I almost hope that's the case in a way, and almost hope it's not in a way. Like I can't think of a more plausible scenario. Obviously they seem to actually think, tariffs are like just like one off and it's over. And the Fed's kind of leaning on that as well now. Like the Fed 2-3 months ago seemed to be like, oh, we don't know that this won't embed itself a little bit. Now they're like, oh, it's probably just a one-off, but we're watching, but it's probably a one-off. And maybe in my view of this is skewed by the fact that I'm not that I think, yeah, sure, it's a one-off, but like maybe a 3-year one-off, and that's not the same thing, and that can become its own, its own engine of an inflation problem. But I think they're sleeping on some of the psychological sides of this and the feedback loop sides of this, and some of these less economic things, but more, like to almost like the alchemy view of it, right?
Yeah.
Like, hey, if you embed 3% inflation in people's heads and in businesses' plans and stuff, like, good luck getting it under that, right? Obviously, the Fed's operating as if 3 is the new 2. Like, I don't think there's no way around that. So is everyone. But markets aren't. Like, if you look at where markets think inflation is in 5 years, 10 years, 2 years, whatever, they're acting like, no. Even people at the Fed, they're acting like, no. Like 2% inflation is still going to be totally normal. And the market thinks that, the Fed thinks that, and I think that's insane. But for some of the same reasons we're talking about, like, you don't get to run 7% deficits and have 2% inflation other than if you somehow still get, a very real economic problem. And if you want to have an economic problem while running a 7% deficit, the way you would do that would be to, really mess with trade policy and people's ability to plan and stuff like that, I think. And so I do think you are opening yourself up to the super weird world of a 7% deficit recession, which is, you think it's hard now to figure out if you got into that, if you had a 5.5% unemployment rate in a recession and 10% budget deficit, because you'd have to be up there 10, 12. Like, talk about trying to figure the world out there. Right.
Well, which means that we'll probably have to at some point.
Right. Yeah.
Right. I mean, that's where we're at. Flipping the script a little bit in something that might be loosely related, but probably isn't. Did you read much about this TikTok deal?
I wouldn't say a lot. No.
My only thought about that was, is that potentially a sign that trade discussions are progressing with us and China?
I don't think that is. So when the news came out, like, hey, things are going pretty good with China, I'm like, oh, cool. Like, are we going to hear some news about, important stuff between the two of us, like real, like supply chain, trade stuff, tariffs, maybe Taiwan, Philippines, like, and then it was like, yeah, we have a deal for TikTok. And it's like, really? Like, this is, and my first instinct was like, oh, like, so now, the rat poison that comes at us digitally will be American made instead of Chinese. But then it came out that the algorithm's still going to run from China. And I'm like, well, then what are we even doing? But to your point, I think it's possible. And there's been some rumors that, we're going to maybe get them to buy some soybeans and some stuff like that, like, which we already did 5 years ago or 7 years ago or whatever. So that's not that big a deal. But so I could see we haven't thawed with them. We've just basically, both sides ramped it up to 11. And then we're like, ooh, this actually hurts a little bit. Let's bring it back down to 8 or whatever. Can you go to 7 or 6? Sure. But like, both sides seem too dug in to me to really give way on the things that are important to them. I don't see a world where Chinese tariffs are under 25. I don't see a world where we aren't pushing back on stuff. But important news came out there. China basically said, yeah, no more NVIDIA chips. We don't want them. No more AI chips from NVIDIA. Like, told their people, don't do it. They had done that on a small scale, whatever, like 3 weeks ago, a month ago. But now it's like a hard thing. Like, no, seriously. Which tells you, they have confidence in their own stuff. And they're starting to test their own lithography equipment and everything. So like, they clearly have confidence in their ability to do AI without NVIDIA chips moving forward, which is a huge deal. And it's a huge deal for NVIDIA because that could
I was just going to say
NVIDIA's revenue.
I was just going to say, if they earnestly mean that, and listen, the reason I say earnestly is whenever the CCP is talking, you cannot take it at face value. Sometimes,
but when they tell the private sector to do something, usually they do it.
Yeah. But what I'm saying is, like, you have to consider that face value is true, but you don't take it to the bank, right? So we'll hold off judgment of all that. if that is in fact the case, if they are going to do that, the top's probably in on Nvidia.
And it's hard for the top not to be in on other stuff. I think if it is in on Nvidia,
right? Because if you think that those, if China can get by and not fall behind in the AI race without Nvidia chips, whatever chips are enabling them to do that, they're going to be more than happy to sell to other people.
100%. And knowing China, they will catch up on quality. The price will be better, so they'll sell a bunch of them to everybody other than people we can like put in a headlock and threaten to do something to if they don't buy ours, right?
Yeah, and I would suspect furthermore that those sales come directly out of Nvidia's pockets. You know what I mean? Like that is a direct.
And if you look at Nvidia's sales to Singapore, Japan, Korea, that may be getting funneled to, especially Singapore, may be getting funneled into China to begin with. If those were to dry up, like it's worse than it sounds. Mm-hmm. Like the headline China exports, like if they lost that, it sucks. It costs them tens of billions of dollars or whatever, but like they can live. But if it's like all of a sudden, you know, Singapore's orders are down 60%, even though Singapore pretends 95% of it stays in Singapore, or Nvidia pretends that, they put a number on it. It was in the 90s. And I'm like, come on, man. Like, no. At least 10% of those are finding their way to China. Let's be real. Yeah. Then yeah, Nvidia has a problem. Like that, then you'd have to have that quarterly call where they're like, look, guys, it's next year is going to be weird.
We got to dial back those projections.
Yeah. No. And especially because it's not like because we're not giving them the cutting edge stuff, there's not like a market for that stuff the way, if it was their super cutting edge stuff that people can't order enough of anyway, like whatever, someone's going to buy it. But if it's the ones you made basically for China, you put the governor on it, like no one's buying that. So that's just lost revenue.
Well, and it's not, the other thing too, is it's not just lost revenue. It's going to compress margins. Because they're
right. Because other people will be like, "What do you got over there, Huawei?" You know?
Yeah, and they're like, we'll give you 20% off if you stick with us, or 15% off, or whatever. So not calling a top, not telling everybody to sell their Nvidia, but if I was substantially long Nvidia here, at the very least, this would be making me take profits.
Yeah,
at the very least, especially when you start looking. I mean, you're talking about a company with a $4.5 trillion market cap, right?
Right.
Whatever it is, close to that, whatever. And just all you need to do is go in there and say, let's say their sales projections are 15 to 20% too aggressive and their margins are the same.
I mean, that's 50% of market cap.
Boom, gone. Poof.
Right.
That's the trouble with owning something that expensive. They're like, what do you mean? Look at the PE ratio. Yeah, but guys, we'll go back to it and say, nobody has ever sustained 70% margins. So in my opinion, if you're really trying to get a handle on Nvidia, you should probably be looking at it. And again, I'm not an expert on this, but in my mind, if I was looking to buy Nvidia here, I would assume margins between 30 to 40%. I would scale those back.
I think it's at least fair to say you better be comfortable in your own model with a pretty significant contraction in margins moving forward. If you can pencil it all out with that and make, maybe you can make a case, but if you're penciling out the margins staying even close to where they're at, like you probably have a problem.
Yeah, they won't never have like that.
You would have to. It would have to be the amount of growth they would need to make up for that would be just crazy.
Yeah. Anyway, you got anything else? I don't think of it. I mean, Fed Day was the biggest thing today. The TikTok thing with Ellison and Oracle and those other guys, that was it. Other than that, I didn't see anything too jarring or too noticeable, other than the fact that I will say this. Now, the fact that I'm saying this probably means the exact opposite will occur, but everything I am seeing still leaves me very unsettled over the next 2 to 3 weeks. I think that
I'll add something to that. And that is we have options expiration at the end of this week. So there's a ton of positive gamma in the market because it's almost options expiration. And interestingly, the tier 1 alpha pointed this out, that there's like 85% of Fed meetings are like right before options expiration. And they're like, we're not saying they're doing that on purpose, but that's pretty smart if they do. And it is, because you end up basically building this buffer where like it's really hard for the market to go down and stay down because all those options either are incentivized to bring it back up, And you can see that today. Like at one point, the market was looking ugly, and then it's like a beach ball, right? So you kind of clear the decks of that stuff at the end of the week. So you kind of start fresh next week. It doesn't mean anything has to happen. It just means it opens you up to the possibilities of issues. And the reason that's important is it doesn't take much of a wiggle at this point to get. I don't know. I've talked about this ad nauseum, but it doesn't take much of a wiggle at this point to make vol control sell, CTA sell.
Well, and here's
and then you have an 8%, 7%, 5% drawdown for no reason other than some machines had to sell.
Yeah, and look, and if people are like sitting there going, well, that's so myopic, or that's such a small lens to look at the market through, or whatever. You go, guys, look at the market. Look at this market, right? Why do you have to be, when you know that a market is being driven more mechanically than it is fundamentally? It's not foolhardy to pay attention to the mechanics. And we
talked about the net issuance yesterday.
Yeah.
That's super important mechanical input.
Well, and you and I, and we've talked about this at great length too, but you and I have seen it over and over and over. This market does not price in data the way it is supposed to and the way it has historically done it. It just doesn't. You cannot tell me this is an efficient market anymore. It is not. It is, because the market is supposed to be pricing in every single piece of information that comes out. It just doesn't do that anymore. And so this is exactly one of those scenarios where you're sitting there going, traditionally what the market is making me think right now is the risks that I see are overblown. The market clearly doesn't care. It's best to stay long historically. Okay. Problem is I've lived through the last 7 years, and I have watched this market walk seemingly blind and drunk into events where you're like, the only reason we didn't do better on those events is because we were worried about the fact the market wasn't reacting, right? And so I just think you need to be very careful here. And the problem, and again, not predicting this, but the other reason you need to be very careful is look at how many, if you have an event in an environment like this, a lot of unforeseen things can take place, right? Yeah. Like we're talking about, it seems like every single day now, a new fraud story is coming out, right? I just see all the, I'm not making a prediction. I've done this too long to make predictions over short terms. I will just say though, that part of that is a function of how good of a year we've had, right? Take that into consideration. Just, I want to be very cautious and very, keep one eye over my shoulder until the end of this year. I just feel like there's some serious vulnerability, especially in the next 15 to 30 days.
And in a 5% 7% drawdown in the next month, grand scheme, not a big deal. But I think we reached a point, especially if the economy is a little fragile here, where it's important to remember that 7% drawdown could start impacting the real economy. Like if people feel really pinched and they stop spending, that could become its own fundamental. So like every potential drawdown becomes its own potential catalyst. Now that may be a 15% chance of being a catalyst, but like it's always important to keep in the back of your mind, knowing that like, are we still a weighing machine? Maybe, but passive flows and overseas flows, their votes and they are the voting machine right now. So if their vote changes, it's a huge deal.
Yeah. And I think when you really, really stretch it out over a much longer term, I think we still are a weighing machine, right? For the most part. I just think that shorter term, the market has always been irrational over shorter term. I just think shorter term has been expanded. I just think the market can be, I think it takes much longer for it to truly act as a weighting machine.
Right. Our vote is tiny. And,
yes.
And the 401k inflow vote is huge. The foreign capital inflow vote is huge. Like me, you, even Warren Buffett, we have tiny votes. He's moving hundreds of billions of dollars and his vote doesn't really matter. But if you're Vanguard, BlackRock, or if you're the Swiss pension fund or whatever, or Swiss National Bank, like you have a big vote. Like your vote can move stuff.
And I think it's so important. People are like, oh, what's the difference? What's the difference? And I'm like, look, the difference is, and I ignore at your own peril, that for the most part, for better or worse, in the past, you've had exuberance, you've had pessimism, all that kind of stuff. But stock prices reflected future expectations of investors. Today, they do not. Today, they predominantly reflect flows of passive funds,
and the overseas capital. It's a lot of money,
which is purely a function of size, right? For 98% of them, just market cap weighted.
Last thing for me, we talked about this right before we came on the show, but like the news came out that Sherwin-Williams was suspending their employer match of 401k money. That's just one company. It's not even a huge company, but if that were to become a trend, then all of a sudden you're messing with that passive flow machine to a degree. So let's say we do have a recession, or we come close to one, or whatever. This gets ugly. Unemployment goes up, corporate profits come down, yada yada yada. If enough companies looked over at Sherwin-Williams and are like, "Hey, let's do that." Like, first of all, it's a political problem probably, but more importantly for markets, that's a flow problem. So just as an emergent trend, that is something to keep an eye on. For one company to do it matters not at all, but if that becomes a trend, that matters a lot.
And it could be a fairly pernicious one if you think about the fact that it disrupts the flows, right? Which we all know. But, the impact you're going to have to wait and see. Here's the other thing is that when you get that 401k contribution pulled, it may not impact your paycheck, but it's not going to make you more likely to consume.
Right. You're going to look at your 401k statement at the end of every quarter, year, or whatever, and go, cancel vacation.
Yeah. And maybe could even get you to pause your own contributions going into the 401k.
Yeah.
Depending on how stretched you felt, right?
Some people only put money in there because they know they get the free money match, right?
Yeah.
Some people aren't disciplined enough to do it without the match.
Yeah.
You can argue they're not crazy either, too.
Yeah. Yeah. And that's the tough part. I mean, that is really the tough part about this market, especially the stuff at the top, is there's so many people know that it's not really big chunks of it are not economically supported. Right. And we know why it's there. And that's what makes it so dangerous is at any moment, those dynamics can flip and they can become their opposite. And if they do, Katie, bar the door, man, it can get nasty.
Yep.
Anyway. All right. Well, that does it for us today. Unless you got anything else, you good?
Good to go.
All right, you guys. Well, you guys know, as always, not hard to find. Just Google Know Your Risk Podcast. You get the video feed on YouTube. Just search Know Your Risk Podcast. Go to knowyourriskpodcast.com, BulwarkCapitalManagement.com. Name of the game, folks, is risk management. Make sure you're staying frosty over the next few weeks. Hopefully nothing happens. But, man, those spidey senses are tingling a little bit. So, anyway, we'll see you guys tomorrow. Have a wonderful evening. You're listening to Know Your Risk Podcast. Download and subscribe to knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC-registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.